Time for another stock review. We're looking at DocuSign. Can you make money on this? Does all the money add up? Let's do our figures and look at the numbers on the board. Weigh it all up. Scratch our chin. Yes, you've guessed it by now. Let's do all of that. Look over the numbers and make an informed decision whether we should buy, hold, or sell this stock. Is it one for you? What is DocuSign? Well, tap the like button. Consider subscribing, and I'm going to show you all the amazing things that you're going to get in this review. You're going to see the balance sheet, the profit, the loss, the intrinsic value. Going to use the most advanced algorithmic software, which you'll all be able to get access to. Look at the margins, look at the basic numbers, the deep numbers, the insolvency score, who's buying on the inside, who's selling on the inside. Let's take a look at the website, latest news, insiders buying and selling, what's going on, what about how it compares to the S&P 500. All of that coming up in this review, so you can make an informed decision whether this is right for you. Can you make money from this stock? Well, full disclosure, I only own the S&P. I'm 100% in the S&P. I don't own any individual stocks, just the S&P. That way you know my views are real, honest, genuine, unbiased. Not here to promote, sell anything. I'll never message you saying, hey, buy this, buy that. But of course, if you want to buy one of my mugs from the shop, be my guest. But I won't be messaging you to ask you to buy or sell or do anything. I'm just sharing with you my opinions, and that's all they are. But they are based on the truth, honesty, and no bias whatsoever. So if that all appeals to you, click the like button, click subscribe, ring the bell. This is being done for one of our members. If you are a member of our channel, we'll do a full review for you. Yep, you can do it for just $1. Absolutely. As a member, you can get a review like this, up to half-an-hour video, which will not only provide you information, it'll trend on YouTube, very often number 1 or 2. It also accompanies Meet the CEO series. I interview CEOs on my show, and we'll tell you how you can get the CEO. You can get the CEO of this company on the show in a few minutes. So without further ado, let's get straight into it and discuss what DocuSign is. Right, let's start from the very beginning. Did I ask you to subscribe and tap the like? Quite a few times, probably should leave it by now. Let's take a more detailed look then at DocuSign and see exactly what it is. So here we go. Let's have a look at the main general... Oh, hang on. Look at this.
Charlotte May Weddings Limited has become a member.
We've got a new member, a new sponsor to the channel. A brand new member has just become a sponsor of our channel. I'll talk to you later on. That's wonderful. That happened during a live broadcast. We've just got a brand new sponsor of our show. How cool is that? I'll explain the benefits to our sponsor and all of you shortly. Let's go straight now into the position here. Let's look at the line chart, the general line chart. As you can see here, back from 2018, it popped on COVID. Now we're going to talk about this in a minute when we get to comparing to the S&P. Straight away, I don't like it. I've got high standards for what stocks I buy, and that is straight away out of the can, because what we had was a macro condition play there. What that means is COVID happened, and that changed the landscape. Everybody went online, a bit like Zoom. This stock popped and then it collapsed afterwards. I don't like that. So straight away, this is a stock that is subject to macro conditions. I want a stock which grows to macro conditions but continues to grow afterwards and not sell off. So straight away, I'm saying no buy from me, just like I wouldn't buy Zoom. All right, there are stocks that were affected by COVID that collapsed afterwards. They were trading plays, not interested in stocks like that. I buy stocks I can own for 20 years, not for 20 minutes. That doesn't interest me at all. So there we can see a very good example of a COVID play. Let's carry on now. DocuSign provides cloud-based electronic signature solutions. Its cloud-based electronic signature platform helps companies and individuals securely collect information, automate data workflows, and sign anything. Show more, absolutely. The firm automates manual paper-based processes, allowing users to manage all aspects of documented documented business transactions, including identity management, authentication, digital signature, forms, and data collection. Collaboration, workflow, automation, and storage. DocuSign was founded by Thomas H. Gonser and Court Lorenzini in 2003 and is headquartered in San Francisco, California. Listed name is DocuSign. Okay, we have Alan C. Tygeson. I hope I pronounced that correctly. Alan, I'd love to have you on the show. However, I don't go to anyone and sell my services, but what I do is I invite you to join us on a Meet the CEO series. I've interviewed many CEOs and I've got many more planned in the future. To be on our show, it's simple as this. The investors or yourself or your company will get to see this review because it will rank on YouTube. But normally what happens is investors email investor relations. They contact you at investor relations or directly or create a group around this stock, reach out to you, build a relationship, let you know that they are investors in your company and invite you to be part of my Meet the CEO series. And then you can communicate with them. And if you're interested, eventually they'll put you in contact with me. My email is martyn@martynlucas.com. And you can be on the show. We'd love to share your story with the world, and maybe you could put me right and tell me that it's more than a COVID play. But anyway, I'd love to have you on the show if you'd like to, and that's how it works. All right. Employees, 6,840, San Francisco, 2003. It's regarded as quite safe stock to own, this one. If you buy it with margin, it's 25%, which is the lowest. $10 billion market cap's quite a decent sized business. 52-week high, $64. 52-week low, 38. So quite a bit of volatility. 104.79, 105 is the price to earnings ratio. Very expensive. Trades on huge multiples. No dividend yield, just growth stock. 2 million is the average volume. 1.31 is the volume today. So don't expect any short squeezes. All right, let's scroll on down and let's look at the trading trends. What we've got here is the how it's trending on Robinhood. You can see it's being traded. It's a trading stock. It's exactly what I'd expect. It's a trading stock, not a long-term investment. Hedge funds, who's buying it? Well, a little bit. Let's scroll down here. A little bit of movement. I'm more interested, though, in those that hold the stock. We've just seen a sell here from Couture Management. I think that it is Couture Management. They've just dropped to 6.5% of their allocation, 4.5 million shares. What about Bridgewater Associates? They just bought 267,000 shares, which is $23 million worth of shares in Q1 of 24. So a bit of buying going on. What about insiders? Let's look for inside trading. Let's have a look at that. See what insiders are doing. This is very, very important. Inside positions. Well, back here we had October 23. We had a 43% buy and a 57% sell here. There we go. What about recently? It's scaling down. It's a 50-50 one, this. It's not all buying or all selling. It's a bit of a 50-50. But who is buying? If you follow who these people are. Here we go. The president and CEO, very important. He sold, but this is only a automatic sell transaction. We're going to come on to that news in a minute. This doesn't matter. 7,900 shares, no big deal. At 425,000, no big deal. That's just tax purposes. Look, automatic sell transaction. It's not the CEO going, I don't like the stock, I'm selling out. It's simply no more than just tax positions and reallocation. Nothing there to worry about. In fact, if you scroll down, insiders, automatic sell, accumulation of shares via a grant. So that's compensation. No one's really buying or really selling at the moment. So there's nothing really to shout about when it comes to inside trading going on at the moment. What about analysis here? This is Morningstar. I don't follow Morningstar. I have access to it because I'm a gold customer, but I'm not bothered what they say. They're paid to say these things, so who knows what's right and what's wrong. The bulls say DocuSign's market consists of considerable more greenfield space than its typical within software. What about bears say, as the company moves upstream to increasingly larger clients, it is likely to face intensifying competition, particularly from Adobe. Absolutely. Adobe is the king in this space. Don't see DocuSign doing as well. Anyway, again, this was a COVID play for me. I'll come on to that, what I mean by that in a minute. Let's scroll down. Fair value is $65 according to Morningstar. I'll tell you in a minute what the fair value is, but they're saying 65, which means it's undervalued at 52. Okay, sounds great. Economic moat, none. In other words, their margins are slim. They can't really reduce prices and sell less to weather the storm. They've got no economic moat, not good. Uncertainty, high, not good. Standard stewardship, not great. Okay. What about earnings? Well, it looks like it's making some money, but is it growing? Well, not really. It's going sideways. Now, nothing wrong with that. If you own Coca-Cola or J&J and it does the same thing day in, day out, makes money day in, day out, not a problem. Is it growing anymore? I don't think a business, a stock like this can really grow. As it demonstrated, it was a macro play, and that was great. It exploded. It was a chance for it to be introduced to the world, then dumped afterwards. That just says no. If it carried on going, even if it had gone back but not as low as it was, at least it gained something. But to go back from where it was, that doesn't interest me at all. So it beats on earnings, which is good, but going sideways. And if we're not getting a dividend on the stock, what's the point of owning a stock that goes sideways? Not really much point, is there? Anyway, there we go. Let's scroll down and see what else we've got here. Who else are you buying the stock with? Like I said right at the beginning, Zoom, Shopify, look at this, all COVID stocks that popped. No surprise. People bought back in 2020. Thought it would be a great idea, makes perfect sense, and really it's just gone back to where it was. No, waste of time. I wouldn't buy Zoom, Block, Upstart. I don't know about these last three. I've never reviewed them, so I can't comment, but I can see that it's in the Zoom camp, which makes sense of why it looks like that. So far, it's not a buy from me, okay? So no, tap the like button if you like this so far. Let's go and have a look now, and let's go and look a bit of the news around the stock, and also we'll look at the website as well. So let's go and look at that now. Here we go. So everything you need to agree. DocuSign, as it says, online you can sign. Adobe do this, not the only ones. Anyone can do it. Anyone can come up with a solution. Now, don't get me wrong. I'm not saying it's easy, but where there's a will, there's a way. They don't do anything proprietary and unique. Anyone could do it, right? Adobe do it. So would I invest in this so far? No. And not very innovative website. It's clean, but a bit basic, I think. It doesn't inspire me to jump in, but then it wouldn't do. The website really doesn't need you to do that. It's just telling you what the product is, and you want, you want something that can sign documents. This is an option for you. There are so many options available today. It's like Netflix. I wouldn't invest in Netflix. There are so many online streaming services. Which one do you choose? It makes you very vulnerable. The news, DocuSign CEO Alan C. Sells the shares. We just covered that in the trends, and it's not a big deal to me. It's not a concern. This is just normal tax positions. I'm not going to look at that and go, that's bad. Prefer to see him buying, of course, but you want to be buying yourself before insiders buy, not after, because by that point the stock has already popped potentially. There's a bit more on DocuSign. Now then, I want to share this with you. Before I go into the numbers, the balance sheet and all the rest of it, I want to share with you this here. This is what I'm talking about. If you put $10,000 back in 2019 in the S&P, you've doubled your money. You've got 23 grand now. You're very happy. If you put $10,000 in DocuSign, you've got 13 grand. You're still happy. You've made 3 grand in the last 5 years. Well, it's all right. You could have made more, but hey, you've made money, not to worry, whatever. And that is reapplying the dividends in the case of the S&P. But look what I mean here. You've got the S&P in 2020. It just had a little shock on the pool, little ripple on the pond, went down as most businesses did, and then carried on rising. It wasn't really affected by it. There was a slight pullback, but we carried on growing. Our investments, our long-term investments, didn't get shocked. They carried on growing. Well, DocuSign, everyone's online. We need this. Let's all buy it. Boom, up it goes. Everybody bought it, and then it came back, but it didn't then continue along the line of the S&P. It dipped below it, and it's continued dipping below, lower and lower. So it got all that, if you like, publicity of how wonderful it is. Everybody's using it. Everybody's buying it. However, maybe everybody bought the stock, but not everybody used the platform. Well, obviously, because if they all have loved it and they made loads of money, the stock would have remained up, or at least above the S&P, with all this free publicity, if you like. But in fact, it's below, and it's continued falling below. So again, another reason not to own it. Prefer to buy the S&P. There's no point to it, in my opinion. But now we'll look at the numbers. So let's go and look at the numbers now, and we'll see if now it actually makes sense. See if we can draw something from this. Okay, so let's go and look at the numbers, and we'll go onto the board here. We'll do our figures, and we'll see if we can scratch out a profit on this stock, shall we? All right, let's go and have a look. Tap the like button and consider subscribing to the channel, and there we go. Right, so let's have a look at the numbers. All right, okay. Let's see how it all stacks up. Let's start off with the intrinsic value. The intrinsic value is very, very important. And this one we can rely on. Here it says our valuation is $73. Now you may remember a few moments ago when we looked at it, Morningstar gave a general fair value of, I think it wasn't it 65? Something like that. Yes, 65. They are saying is the valuation, 65. Okay, which is quite nice, right? Considering where it is today, it's valued, it's priced at 52. We're saying on a base case, it's worth 73. Best case 100. Worst case 59. So there you go. We're saying it's worth slightly more than Morningstar. And it's a reliable earnings. It's a reliable valuation. So you might go, well, why aren't we buying it then? Sounds great. Why don't you buy it? Let's look at the financials, shall we? Right, revenue. Revenue is up 2%. Now you can see it's growing, but not much. It's not really, it's not a Tesla. It's not an AI play. It's just a steady growth. And we're not going to buy this hoping we get another COVID situation, are we? So, it's growing. But again, it's growing less than the S&P. What's the point? Why risk it? Operating income up 43%. Operating income expecting a bit of an S-curve, at least for the next couple of years, and then slow down. So maybe buy it for a couple of years. Net income is up 45%. Financing cash flow down 16% at negative 1.1 billion. Investing cash flow, we've got no latest figures. Operating cash flow up at 2%. Okay. Balance sheet, 2.9 billion in assets, 1.8 billion in liabilities. So liabilities are a little bit close to the assets. I like to see a nice 80% difference between assets and liabilities. But what makes it worse is if it's long-term debt. Let's have a look. 2.98, of which 1 billion is cash. That's okay. Don't like too much cash sitting around though. Not when interest rates go down. You need to be able to spend the cash on building the business to make more money, not just sit around earning interest. When rates come down, then what are you going to do? Right. So let's have a look at the long-term or short-term debt. It doesn't appear to have any long-term or short-term debt. That's good. Just ongoing costs, ongoing running costs, no debts. That's good. So we've got a nice balance sheet here. The balance sheet isn't going to underperform and be scary, and we don't have any debt really. So we're well funded. Gross margin, 79%. Sounds great. However, you need to compare it to the competition. Adobe. We'll come on to how you can do that in a minute to determine if you're interested in this sector, which is the best buy. That sounds great. But operating margin is 3%. Net margin is 4%. Very, very different than the gross margin. That's what you end up with. FCF margin, 32%. What about ROCE, return on capital employed, 8%. Okay. All positive though. All moving nice in the right direction. Return on invested capital, 4%. That kind of makes sense. It's about the interest rate, isn't it? About 4%. So basically put the money in the bank, I can get 5%. So that's basically what that is. Return on invested capital. All right. Anyway, whatever. Return on assets, 4%. Return on equity, we've got 11%. Let's scroll down to our next thing. We've got our overall profitability score, 50. Pretty good, but we need to compare that to Adobe. I'm going to give you the link in a minute so you can do it for yourself. I'm not going to do it for you. What about solvency score? Like I said, they're not going bust. They don't have any short-term or long-term debt. Got a bit of cash. They've got a bit of money. It's great. It's not a big cash cow like Amazon or Apple, but it's making money. It's got some cash. It's not going anywhere, but it's probably going to go sideways. Now then, Wall Street. Wall Street say worst case scenario, 7% downside, 23% on the average upside, which is good. Beats the S&P by about 10%. And on the highest, 72%. What would be the catalyst to take it to the highest? I don't know. Now, here's the competition. Very, very important. I'm going to show you how you can go to that. So very, very quickly, let me click on Adobe just quickly, just to give you an idea how this works. There's Adobe for you. You can use this software. I'm going to give you a link to it in a minute. Look at their margins, gross margins, net margins, moats. Oh, there you go. You just buy Adobe. I mean, you buy the best, you buy Adobe. 74%. You can see the difference, right? The upside, 10%, not as much because it's already grown, but it's a much more solid company. I would be buying Adobe if I liked this space. However, let's come back to where we were, and you can decide. You can do more research into it, and there's other synopsis, other ones you can look at. Insiders have been selling, but we looked at it. It was mainly for for tax purposes. Nothing great. But remember, when we see selling getting a little smaller and smaller and smaller, that's quite good because you think then we're going to start getting buying. That's what happens. So you could be buying just before, the next round of inside buying. So that's quite good. Short interest, 4.77. No major short interest. I don't expect a short squeeze on this stock. News, sentiment. Let's have a little look. 1 month ago, nothing particular. Shall we hear a little bit of this? 1 month ago, DocuSign slips after earnings. We'll hear a little bit here, just for a few seconds.
The quarter was, we'd call it certainly on the soft side. Their net new sales look like they took a leg down from both expectations and the minor recovery the company had seen over the last year. But this is a company that obviously was a huge pandemic winner, and the business is just trying to kind of right-size itself after a couple of years of massive growth.
I was kind of wondering yesterday when this number came out if the market would finally kind of get its head around its new standards for the stock, which is basically single-digit growth. I guess maybe the answer is no. Do you think it's just still like a brutal comparison? Folks looking back at when they were booming and saying, all right, I don't need to own this right now. I mean, valuation's gotten punished already, has it not?
The stock's obviously had a really tough 2 years for a variety of different reasons, whether it's just my general space has fallen out of favor, but then two, growth has decelerated meaningfully. But I think your average investor that's involved with it today is really trying to, grapple with two items. Is one, what is the right kind of durable revenue growth rate of this company? over the last couple of quarters, the expectation was that this might be able to grow at 10% again sometime in the near term. But the last quarter, last night suggests that maybe, that mid single digit growth rate's the right one. So some expectation differences there. But then too, on profitability, for a slow growing stock in my space, the margin structure, while it's improved a lot the last 2 years, is still suboptimal. And the leverage that we're getting this year is maybe not as much as you would expect if the growth isn't there. So kind of at this interesting point, is the company going to be able to drive more growth, or is it going to be more profitability driven? And at least in the quarter, we're finding that we didn't get either side of that equation.
Yeah.
There you go. Just basically what I already said. If we go down to the sentiment, the last 90 days, 56% positive, not bad at all, right? Last 30 days, 57% positive. Last 7 days, just one news item, all positive and nothing today. Okay, so there is my review on DocuSign. So let's have a look at it. Let's review the facts and decide whether it's worth buying or not. Please do tap the like button if you like this, and subscribe and ring the bell to this news. Now then, first of all, if you'd like to use the software that I use before I give you my final conclusion, it's provided by AlphaSpread, and I partner with them, and all my members can get access to this for free. Click above my head for martynlucas.com. You'll find all links. Scroll down and you'll find AlphaSpread, or look below in the description and you'll find it there. If you are a member of my channel, you can also have the premium service, which basically makes the discount that you get, makes my membership for free. I insist anyone I partner with gives me the best deal, and it is without doubt the best deal. No one has the deal like that. The software is groundbreaking, always gets better. I love it. I use it all the time, and I highly recommend it. I use it all the time to review all of my positions. So that's how you get hold of the software. Now then, as far as the stock's concerned, obviously I don't own this. I wouldn't own it because I only own the S&P, so I can be impartial on my channel. That's what my channel is all about at the end of the day. But if I was trading, would I buy this? No, I wouldn't buy this. It does have some cash. It does have a good balance sheet. It's not got any really meaningful debt, or short-term or long-term. That's good, but its competition is far ahead, and its only benefit was the COVID play, and that gave it an opportunity to grow, and then it just collapsed after that. So really, there's no reason for me to want to buy this. There's no positive to say why I should buy this stock. If you like this sector, you might want to go and check out Adobe as instead of. But really, the only reason why you'd be buying this is if you felt that there could be some online explosion because of some macro condition. Then you're just basically gambling on another COVID outbreak or something like that. I don't know. I don't see the point of owning it. I think there's better stocks to own. It is potentially now good value, but when people say it's good value now, that's because based upon what it did before. Well, what it did before happened because of COVID, not because it was great. Because of COVID, it did what it did before. So to say if you hadn't had COVID and you'd just took that curve out, it would have been flatlining for the last 4 years. Well, then you definitely wouldn't be buying it, would you? There'd be no point. If it had a dividend attached to it, you might consider it because you'd be earning a passive income. But other than that, it's an interesting company. I'd be a customer, but I'm not an investor. I don't see it as the best use of my money, to be honest. I'm sure it's a great place to work, and people that work there get paid and they make money, and people that use the service like it. I think I've used it a few times myself, but I don't see any point in owning the business. Not for me at this point. Click above my head for all the links. martynlucas.com, AlphaSpread's up there and down below in the description. Also, I'll put all the links as well. If you go down in the description, you can open up the More button at the bottom, and it will open up all the links where I always talk about what's above my head. Go and check that out, and you can see there. Over here, I'll put the full Alpha Spread playlist. I've reviewed nearly 200 companies now. Go and check them all out. And down here, I will open a playlist for DocuSign. So if there's any news, any earnings, anyone wants me to cover the earnings, they'll all be down here in its very own playlist. Until next time, as always, take care of yourselves and each other.